Well, let's go ahead and get started. So thanks for everyone who had an opportunity to jump into our webinar today. I do these weekly, and it's just an opportunity for me to share about my backstory, how I got to where I am today, and just give back to people who are trying to get into this space as well. So the topic today is how to quit your W-2 job to become a full-time multifamily investor. So I became full-time actually back in April. And, it's probably one of the best moves I've made because I've realized that I'm worth more to myself and my family out as an entrepreneur compared to, when I was working for someone else. And I always wanted to be an entrepreneur, but I think there's a specific blueprint that I've found that's extremely helpful when you are transitioning into the world of full-time real estate entrepreneurship, specifically in the world of real estate private equity. And I wanted to come in to share that today because I think it'll be extremely helpful when you are conceptualizing like what you need to do to make sure that you are focusing on important items. So without further ado, let's go ahead and get started. So as I mentioned, my background is in real estate private equity as an asset manager for multiple retail and institutional private equity firms. You leverage that after playing in the NFL for the Tennessee Titans. It was a way for me to really learn the game internally and be around people who are writing those checks and executing different business plans. And from there, I leveraged that education and that experience to do the deals that we've done, syndications that we've done in Northeast Baltimore. And today we are actively looking for more and more deals, and happy to talk about that, once we continue at the end of the webinar. So how to quit your job, right? I know there's a lot of people out there that really don't like working for, corporate companies and are trying to figure out, a way to step into the world of real estate entrepreneurship, specifically private equity, right? Or just doing your own multifamily deals at a high level. And today, I'm definitely going to touch on some points that I think are really, really important when you are thinking about how to actually quit your job and put yourself in positions to quit your job. And then also the pillars that I think are extremely important as well. So you definitely want to develop your exit plan, right? I have this thing I always like to say, if you fail to plan, you plan to fail. And that's one of the things that I really focused on, was figuring out like, what does that exit plan look like? And what do I need to focus on to make sure that when that transition starts, I'm able to actually be successful or set myself up to be successful, right? Because when I left my private equity position back in April, the owner of the company, they had about $2 billion in assets under management. He told me this was going to be the hardest thing that I've ever done in my life, right? Because real estate private equity is hard if you don't have the resources behind you and you don't know how to set up your infrastructure. So what I came up with was 6 pillars that you seriously need to focus on to set yourself up for failure in real estate private equity, specifically when you're growing a multifamily business. So the first thing is figuring out your investment strategy, right? Because one of the things that I did when I started in the world of commercial real estate was I spreaded myself too thin, right? I was trying to find deals in Florida and Texas and Georgia and all of these places, but really I didn't have a solid investment strategy of what I specifically wanted to focus on. And when you have that focus, that brings clarity to your investment strategy. And when you have clarity, now you're able to have that elevator pitch. So when you're talking to different people who are willing to invest capital with you, or people who are interested in investing with you, you can get your message across very concise and in a short matter. So focusing on your investment strategy and figuring out where you're going to acquire these properties are really, really important. Another thing that I ran into was, my backyard is Baltimore, Maryland, right? That's pretty much where we own all of our properties. And one of the things that I ran into was I was trying to look for like 2000 vintage, C plus B minus properties in Baltimore City, in a market where it's likely only, for the most part, only has about 30s, 40s, 50s vintage garden style, workforce housing apartments. And so what I'm trying to convey is that I had a completely different investment strategy in a market that was not giving me those properties that I was looking for. So definitely focusing on your investment strategy is extremely, extremely important. The second thing is capital raising. I mean, this is probably one of the most important parts of like real estate, private equity, or just doing larger and larger deals is understanding where you're going to get the money from. And building a system of capital raising is probably one of the hardest things for most people, because not everyone has deep pockets, right? Not everyone comes from a family that has tons of money to, start up, essentially, because that's what you're doing when you are jumping out there to become a full-time entrepreneur. You are essentially creating a startup company, right? And if you don't have the funding behind you, to some degree, that limits your growth. So definitely understanding where you're going to raise that capital is extremely important. The third thing is deal finding, right? Another crucial pillar to developing that exit plan is how are you going to find those deals? And that kind of goes in line with the investment strategy that I was mentioning, is figuring out where are these deals coming from? How can I get them? Am I going to spend my time going off market, trying to find off market deals and finding a great deal? Or am I going to spend my time talking to brokers and figuring out who is that broker I need to talk to in this particular market? Because a lot of times the bigger deals are done by brokers. It's very unlikely that you're going to get a 150 unit property off market with a direct to seller situation, right? Because a lot of times institutions and bigger private equity firms have those types of deals. It's not saying that you're not going to run into it, but it's very, very challenging to. The fourth thing is team members. One of the things that I ran into when I was developing my plan, my exit plan, was figuring out, who am I going to partner up with? And when you're doing these larger deals and you're raising capital from different investors and you have a whole bunch of things going on, like there's only a certain amount of resources that you have in a certain day, right? When you're doing a value add opportunity, a business plan, somebody has to manage the contractors, somebody has to report to the investors, somebody has to be the asset manager. And then on top of that, you're still trying to find deals, right? Because that's essentially how you're going to make money in this business, is by closing deals. So I ended up running into my partner, which, we've done a couple of deals to date. And that was probably one of the best things that happened to me, was because I was trying to do everything by myself. And if you're trying to do bigger deals by yourself that need some sort of construction aspect to it, you're going to run into a brick wall. The fifth thing is systems and infrastructure. Really important here. And this is kind of in line with your org chart and how you want to develop your business. So if you're doing more and more deals, it kind of goes in line with the team members aspect, right? How are you going to develop those systems and infrastructures to make sure that your investors remain happy, right? Because if you're the only person that's doing deals, or if you're the only person within your company and you are trying to wear all the hats, like at some point you're going to drop the ball on some of those things, right? So for us, we have a simple investment portal, right, where our investors can go in and they can subscribe and do all the things that on the administrative side that we don't necessarily want to focus on, but we have technology and systems that handle all of that, right? Who's going to create those reports? Those little things like that, I think, are extremely important when you are trying to manage your time and developing your exit plan to make sure that your business plan is sound, to have that confidence when going out. So systems and infrastructure is really important. I'll just note this right here. I recently had a conversation with an institutional equity partner, and they were really questioning or just had questions about, how we plan to grow as a firm, right? Because a lot of times in the institutional space, what they want to see is they want to see some sort of org chart. Because if they're giving you $2, $5, $10 million to get, to invest in your investment, they want to make sure that that investment is being attended to. So definitely a little bit more color on why systems and infrastructure is extremely important. And then the last thing, right? Survival plan. How are you going to survive when you jump out there and become a full-time real estate investor? Specifically in the world of real estate private equity, I keep saying it, more and more, like these deals are harder to come by, right? It's not like a residential property where you can probably do your own deal and just keep doing deals and deals and deals. What happens if the economy turns and your equity doesn't want to invest with you anymore, right? Or just hold off, right? How are you going to have that survival plan to pay those bills on a monthly basis? For me, I already had a personal portfolio that was cash flowing that I leveraged to keep that survival plan going, right? Or just add it to that survival plan, right? Because in the world of entrepreneurship, I mean, you eat what you kill. So if you don't have that survival plan like behind you somewhere that pays those bills on a recurring monthly basis, you're going to have a hard time transitioning into the world of multifamily. I mean, I hear it all the time from people who are doing things at a high level. Like that survival plan is something that not a lot of people talk about in the multifamily space, or just jumping into the world of commercial real estate, because it's cool to just post pictures and make it seem like you're doing big things on a big level, right? Definitely do not overlook the aspect of understanding where your survival plan is coming from, because you have to eat to make it in the world of real estate private equity. All right. So the next thing we're going to talk about is, how do multifamily operators make money? You have to be profitable to have a long lasting career in this business. And you're likely not going to make a ton of money doing your first couple of deals, because track record should be your number one focus, right? That's going to help you elevate and do more and more deals over time. But you have to understand where your profit centers are in the world of multifamily. So how do multifamily operators make money? So focusing on the revenue streams, the first thing is your acquisition fee. That's 1 to 3% of the purchase price, right? So if you do a $10 million deal, that's $100,000, right? So acquisition fees, obviously, you get paid just for closing the deal, and the more and more deals you do, the more fees you get. Another thing is a construction management fee. And this is just the construction management fee that is paid to whoever is managing the contractor within a value add renovation budget, right? Because somebody has to get paid to manage the contractor. I'm sure a lot of you guys are already in the world of real estate and understand it. It's a lot of work managing rehabs, right? And managing, 50 rehabs on a 50 unit property. I mean, somebody has to make sure that everything is fundamentally sound, and managing that contractor. So you definitely want to make sure that whoever's on your team is getting compensated. Another thing is a refinance transaction fee, or some sort of capital transaction fee. And this is simple, right? For doing all of the work that it takes to execute on some sort of debt transaction fee or some sort of sale. Now, an in-house property management fee, 3 to 8%. A lot of people get into getting an in-house property manager when you have at least maybe like 1,000 units under management or so. And a lot of times, new property management businesses are either in the negative for the first couple of years, or not even making any money, or just breaking even, right? A lot of times that's because might be due to payroll and things that you need to pay for operationally. And as you get more and more doors under management, then that profit center increases. But a lot of times people bring in-house property management on to control the efficiencies within your entire business unit of real estate investing. Your asset management fee, it's 1 to 2% of the net income of the property. Your asset management fee, honestly, you only really make a ton of money on asset management fees when you start to get into properties where the rent roll, the net income is like at least $1 million, right? If you're doing like a small, let's say like a 20 unit property that has maybe a $200,000, net income on the rent roll per year, multiply that by 1%, that's not really a lot of money, right? And so a lot of times what people do is, as you get more and more properties with bigger rent rolls and have, that bigger rent roll pot, you can use that asset management fee to hire a full-time asset manager. And so as an asset management fee is another profit center. And a disposition fee, I think I rolled that into the refinance transaction fee, is about 0.5% to 1%. You get paid for, your time when it comes to selling the property. Okay, the next section that we're going to run into is why cash flow is very, very important. You need that in between cash flow when you're doing these deals. I was just talking to a developer actually about this, a few weeks ago. He's doing large deals, 150 unit development deals. And, we talked about this when you're jumping into the world of private equity. You have to have that in between cash flow, right? Because if you're not closing deals, simultaneously, there's probably going to be a lag between some of your deals. And so depending on how you're running your organization or you're running your business, you got to have that cash flow in between deals to get you to the other side, especially when you're starting off your journey when transitioning into the full-time entrepreneurship and full-time multifamily, right? Because a lot of times when you're doing your first couple of deals, if it's a large deal, you're probably raising capital with maybe 3 to 4 other people, right? And that pot gets diluted smaller and smaller the more people that you have on your team. And so if you're focused on building your track record and you have a lot of people on the deal that's trying to, pile money together to do the deals, your percentage is diluted very, very, small, right? And so starting off, you definitely have to have that in between cash flow, because a lot of times you're not controlling the entire pot, right? You're not getting the most amount of cash flow for your first couple of deals. So definitely think about that when thinking about your in-between cash flow, right? So here are some potential cash flow streams that you could think about when you are thinking about your exit plan, right? It can be savings from your job, right? A lot of people that, save up money before they jump into full-time multifamily investing. It can be cash flow from an existing portfolio, which is something that I did. I already had a portfolio of properties that I just leveraged when I quit my job back in April. Can be cash flow from GP activity, which is what I just mentioned. Your waterfall cash flows from GPs and LPs, maybe after a pref or so, that you split amongst the GP partnership. Can be cash flow from non-residential businesses. Maybe you have a business on the side, like a contracting business that's a part of your business unit that provides cash flow for you to have that in-between money between deals. Can be ancillary real estate business incomes, right? You see a lot of syndicators start coaching companies to have that in-between cash flow. And also maybe a property management companies where they're managing other properties as well. Definitely some of the things that you need to think about when you're trying to understand, like, how am I going to eat in between deals when you're starting off in real estate? All right. So here are 2 skills that you absolutely need to master. I think this is probably the last slide here, right? As I mentioned, as I'm growing my, private equity business and working 80 hours a week to get things to the level that I want to get it to, I realized that there are 2 skills that you absolutely need to master, right? And from talking, I have a podcast too. One of the good things about a podcast is I get to talk to a lot of people who are doing things at a high level that I aspire to. And then also just from learning from other people's journeys, people who have, millions and millions and billions actually in their portfolio, is that there are 2 aspects that you absolutely need to focus on. And these 2 skills are probably the most important skills in real estate private equity. And once you know how to master them, you'll always have an opportunity to make money in this space, right? And they're either raising capital and finding deals. I'm telling you, if you know how to focus on, especially when it comes to raising capital, you would always have an opportunity to make money in real estate. There's a lot of people out here that are looking for capital. There's more people looking for capital than there are deals available, if that makes sense, right? If I went to a meetup tomorrow and I said, hey, I have $100 million I need to deploy, I guarantee you I'd have 100 separate emails in my inbox the next day, right? And so if you know how to raise capital, you know how to find deals, those are the 2 most important aspects of a successful multifamily company or just real estate private equity. So that concludes our very, very quick webinar. I hope that was very insightful and helpful when thinking about, how you're actually going to develop your plan to become a full-time real estate entrepreneur. And I enjoy talking about the stuff that people don't want to talk about, right? Because I'm a full believer in preparing yourself to be successful in whatever space that you're getting into or you're transitioning into. So with this time, I'd love to answer any questions that anyone might have when, they're thinking about how they want to maybe structure something, or how they should think about exiting outside of their job, because I think you definitely have to have a plan to do so. Sorry if you hear barking, that's my dog barking.
Yannick, when did you start?
Yeah, so I went full-time back in April. Went full-time entrepreneurship back in April.
But when did you start doing your own, building your own independent personal portfolio?
So I started my own personal portfolio, honestly, back in 2018. I was doing small deals when I was getting educated in the world of multifamily. So like small single families and 2-unit properties. And over time, I leveraged those properties, that income, to replace my W-2 income.
Yeah.
And on top of that, like we did our first syndication deal last September, so September 2021.
So
And along with that and the properties that we had personally, and the deal after that as well, I leveraged that to have that confidence to go full-time in entrepreneurship. So that cash flow to replace your income is extremely, extremely important.
And which geography is your personal portfolio were you building? Was it in Baltimore or?
Yeah. So primarily, having a little a hard time hearing you. I think I heard what you said. So primarily, everything is in Baltimore at this time, but we are actively looking for operators in other markets, down south. More along the Mid-Atlantic corridor down to the Southeast corridor, and happy to talk to anyone that's in those markets as well.
Yeah, right. And then so when you do out of state multifamily acquisition, you're hiring somebody else to manage it for you. So basically you're managing money and somebody else is on your payroll managing the property, right?
Yeah, so we have a property manager that's handling the property management, and I think that was part of your question. And we're more so, the managing members or the principals that's going out there and raising capital and finding the deals, and also some of the asset management as well. I mean, we don't have a full-time asset manager yet, but definitely thinking about like how you're going to structure those teammates or those team members when trying to put together or execute on a lot of these bigger deals are extremely important, because as I mentioned, somebody has to oversee the contract, or somebody has to do the asset management, somebody has to report to your investors, create the reports on a monthly or quarterly basis, and do all of the things after the deal, right? A lot of people try to talk about, how to raise capital, how to find deals to actually close the deal, but the real work honestly starts when you close the deal, because if you close and you can't deliver for your investors, then your investors are the lifeblood of your company. And so then you don't have repeat investors, or those investors aren't able to give referrals, and because of that, now you don't have a business, right? So definitely having those systems and that infrastructure is extremely important, because you want to still perform on the deals like you said that you would, but you still have to acquire more and more deals because you want to grow your company, right? And generate more fees and do more deals. So it's like that infrastructure part is something that not a lot of people really talk about, and you don't realize until you've actually like gotten into some of these deals before.
So tell us more about the infrastructure part. So you got these systems you're talking about, right? Like maybe like a CRM system, automatic email system, reporting system. So I don't know if you can tell a little bit more, maybe.
Yeah.
Like what software are you talking about? What is that system basically?
Yeah. So there's a
I
lot of like
suggest that
little.
after you're done answering this question, somebody else may get a chance to ask a question. That will be most helpful.
Yeah, you feel free to jump. I'm not trying to take your time, Ash.
So we designed adaptive.
No, these are good questions, but
I'll go ahead and answer your question. And we can certainly jump into other questions. I'm happy to do so. So the different systems that we have, on the property management side, like we use Buildium as a central property management software, where we respond to different approvals for work orders and things of that nature. We use an accounting software called Xero, where we're able to have some integrations where we might have an invoice coming in from a vendor, and we just forward that into the accounting software, and then our bookkeeper every month handles the reconciliation of the books, and then we just package that up and send it to our investors. We have something called Trello that we use, where we're managing different renovations that we have on certain units throughout the investment cycle, where we're able to communicate with our vendors, and they log in and they can upload different pictures and things of that nature. So there's one central form of communication, or images and things of that nature that we can collaborate on, and just make sure that the value add construction process is as seamless as possible. And different systems that happy to offline talk a little bit more about, but I think that infrastructure is extremely important, because you want to try to make things as smooth as possible. So did that answer your question?
Yes, it did. Thank you.
Hey, Yanni, thank you for your time and spending time telling everybody and teaching everyone about your experience and answering these questions. My question for you tonight is, what's more important, quality of deal and return, or volume? And I mean that from an operator side, like an investor side, as well as syndicating and collecting those fees. Which one is more important in your eyes?
So I think from an importance perspective, definitely quality of deals is extremely important. And that's because, like I mentioned, your investors are the lifeblood, especially when you're starting off trying to grow your company, and your investors are the lifeblood of your company. So if you aren't able to raise money, you cannot buy deals in real estate if you're trying to do bigger and bigger deals, right? And so your main goal should be satisfying your investors, and how you do that obviously is by doing getting the returns that you told them that you can get, right? And just having that good experience too. And I think focusing on that is something that will align you to get into deals that would allow you to do so on a conservative basis. Because what I think a lot of people are doing today, as well, as getting into deals where you have to do everything perfect to hit your pro forma, right? And I do not agree with that, because I don't agree with stressing myself out and being perfect to deliver for my investors. And if you are unable to deliver to your investors, and you are also unable to deliver an experience where somebody would want to reinvest with you, then it is unlikely that you are going to be in a position to raise more and more capital for those two reasons. So I think definitely quality of deals is important, and then also that experience that you deliver to your investors by doing what you say you can do, and also just having that quality experience by simply just investing in an investment portal, right? You just gives that professional experience for somebody who writes $100,000 to you to invest in a deal, right? There's some of the little things I think that should be industry standard when you are creating a real estate business that you should have in your organization to deliver to your investors.
Perfect. Thank you. I appreciate that.
So Yannick, thank you for holding this session, and thank you everybody. I wanted to ask this, maybe it will be helpful for other newbies or wannabes like me. If there are like 5 to 10 things you could recommend that we wanna be, in multifamily investing, what do we do 5 or 10 things to develop these most lucrative skills that you highlighted, like raising capital, that's the first one, and then finding deals, that's the second one. What do we do to get our feet wet with these skills, and then to develop them and to become a seasoned person?
Yeah. So I think honestly the 3 most important things, outside of obviously your investment strategy, which is important, right? Because you want to know what you're investing in. I think, from the capital raising side, definitely starting off in your immediate network and figuring out, who's interested. And don't be afraid to like reach out to people, because you never know who's actually interested, right? Yeah. When I did my first deal, some of the folks who were saying like, hey, I'm interested, like, just let me know, I'm willing to invest 50,000, were not the investors on my first deal. And then some people who I did not think were interested, like maybe, people, of faculty that I went to school with when I was, at a younger age, wrote a check, and we never had a conversation before really that much about investing, right? Definitely reaching into your back pocket and figuring out like who's interested is one thing. And then the other thing is just establishing yourself as a thought leader or somebody that, if I was interested in real estate, I should go to this person. Because there's in today's world, I think that your brand is the biggest currency that you can have, simply because we live in a digital society, and it's easy to get your message across instantaneously via social media, LinkedIn, etc., Facebook, etc. And as you kind of talk more and more, you start attracting more and more people. So I think starting with your back pocket and then establishing yourself as the authority in your immediate network is a great way to start raising capital. And then on the deal finding side, one of the things that I did, or even right now, I have, all of the big players from a brokerage perspective that are doing listings in my market, I'm in their back pocket. I'm on their short list. And there's a one thing to be on a short list, meaning that I'm on the list where they blast out opportunities, but it's a short list that you want to get on. And obviously, I think you get on that list when you start closing deals, is when they start calling you about opportunities. And so I think if you focus on just getting on the short list is a great way, but then also finding people in your area who are already doing deals and just leveraging them to get that deal flow, right? Because you definitely want to figure out how you want to fit on your team if you choose partnership, right? If you're just doing things on your own, then you just have to be a one person show. And then the other thing is the team members aspect, and that kind of goes in line with what I just mentioned, was just figuring out what is your role within the big picture, right? There's different hats from an asset management perspective, acquisitions, capital raising, investor relations, construction management, all of the different things that lead to the execution of the business plan from start to finish. And you really want to figure out, if you're not doing it all by yourself, what role that you can play today, right? You don't have to be the operator on your first deal. You can just be the capital raiser. You can just be the deal finder. You can be the construction manager. But definitely figuring out how you fit within those team members are super, super important when you're trying to do your first deal.
Thank you, Yannick. So once you have your close network and you reach out to them for investment opportunities, and then suppose you need to raise $7 million, and through them you raise only $2 million or $1 million. How do you reach out? How do you get the more seasoned, the accredited investors? How do you reach out to them? How do you get to know them, and then get the entire 7 million that you're trying to reach to?
Yeah. So good question. So I never get into a deal where I feel like I can't raise the capital, because it's, if you think that once you have a deal on the contract, the money would come, that's the biggest way to set yourself up for failure. in this business. And if you don't close, that's a stain on your shirt that it's hard to get off. So I would start there and tackling deals that you think that you can handle. But if you are able to network with some of those investors who are able to raise that capital, I think it's just reaching out and just having a conversation, right? And asking them, hey, what are you guys doing right now? Would you guys be open to partnering with me if I brought you a deal? Trying to just reach out in a way that you can add value, I think is a great way to start. And then if you feel like you have that capital raising capacity behind you, then you can start looking at those deals. But if you feel like you could only raise 1 million by yourself, I wouldn't start looking at those deals unless you are able to have that capacity behind you. Because, once you're under contract, there's a lot of different things that you need to focus on, maybe specifically in due diligence, but 30 days to try to raise 7 million can be tough for anybody that can only raise 1 million. So definitely think about that when you're trying to build that capital raising capacity.
Hey, Yannick.
Thank you.
Hey, Ivory.
What's going on, my man? I love what you're doing here, and I love everybody's questions, and I love really just hearing this conversation. So it's a good conversation to have. Question I had, you see a lot of people in the multifamily space, right? A lot of times these people come from IT, they come from equity firms that they worked with, finance backgrounds. Some people come from W-2 jobs. And then you see some people who come up, wholesaling and flipping, right? And so if you could allude to this, like for someone, working 1099 or, who may not have that financing to be able to get, a traditional loan, how do you compare, someone coming from the W-2 background and getting into multifamily space from someone, working their way up from single family homes, single family flips in the wholesaling background? And what do you feel like, which path do you think is best from eventually getting into the multifamily space?
Yeah, that's a good question. So are you referring to loans on the multifamily side or more smaller properties that when I say multifamily side, so let me say this. Are you talking about like larger multifamily? We're talking about maybe 20, 30 plus units, or are you talking about 10 to 20 units? Because it can kind of differ a little bit.
I would say your medium sized multifamily, like 10, 20 unit properties in that space. Yeah.
Yeah. I think it can vary because, we have a couple of deals where we signed as a guarantor on, and it's full recourse. And, we actually brought in some people who had a little bit strength on the deal from a net worth and liquidity perspective. Larger acquisitions, maybe like a 20 plus unit, 30 plus unit that you can take to, Freddie and Fannie Mae. A lot of times they just look at the balance sheet. So they don't really look at the job like that. They just want to see net worth and liquidity. And if you pass those qualifications, then it's likely that your loan is going to go to the loan committee. But on the smaller transactions like that 10 to 20 unit space, it can be challenging because they might not fall into the loan balance bucket to qualify for a non-recourse loan. So you might have to go to a bank, and those banks look at your financial picture, or what they call your global cash flow a little bit more stringently, because they might be taking on much more risk than a Freddie or Fannie Mae. So I think looking at it from those two perspectives is what you need to think about when you're looking at the difference between those deals. The larger deals, they just pretty much look at net worth and liquidity. So if you don't work and you have, a couple $100,000 in your back pocket and you got a solid net worth as well, they would be okay with that, versus a smaller bank that is looking at you from a recourse perspective and looking at your global cash flow. They're going to look at you a little bit more tougher. So when you get into those larger deals, the point is that the income stuff from a W-2 perspective, it can help you, but it's not really that big of a deal. Honestly, they just wanted to see, maybe 100% net worth of the loan and 10% post-close liquidity for the deal.
Got you. Okay, that makes sense. Last question here. So when raising money on your first deal, how do you get someone to trust you to go through with it? Essentially, if you're talking to an investor who is, funding, more than 50% of the deal, how do you establish that trust on that first deal? Because obviously, once you establish that trust and they want to work with you again, but that very first deal that you're presenting to them, how do you what words do you say, or what tricks do you have to get them to go through with it on that first deal?
Yeah, so for me, I think when I did my first deal last like September or so, all I did really was leverage my background, my track record, and my partner's track record as well, because he was already an experienced syndicator. And I think, somebody at the end of the day is really just going to invest with you because they know, like, and trust you, right? Yeah, you definitely have to have the experience, and you can just fill the gap for that with just having a solid team and a solid partnership. But at the end of the day, somebody has to believe, like, in you, and believe that they can trust you, right? And if somebody's not willing to trust you, I think they're likely just not going to invest with you, right? Because your numbers and everything, yeah, the deal and all that stuff has to make sense. But if I don't trust you as a person, I'm probably not going to invest in the deal, right? So it might sound very superficial, but I think, how do you get somebody to trust you? Definitely latch on to a partner and leverage their track record and show that person that you have the right team to be successful. And at the end of the day, people are just going to invest with those who they trust. So if they don't like you, they're probably not going to trust you. But if they like you and they like your team, then they would probably trust you, right? I hope that kind of helped that your question.
No, that helps, man. That's 100% true. Thank you.
So that's an interesting thought that you presented to Ivory's question. So basically, you need to find people who are already, like, trusted by the investors, and then try to partner with them when you're new or trying to enter the industry, right?
Yeah. I think my volume is down for some reason, but I think I got your question. I think you were asking about, basically, you just need to find people who trust you to invest in the deal with you.
No. What I'll try to speak loudly. What I'm trying to say is, basically, if you are new and you're trying to enter this industry, it may be best to partner with someone who already has earned the trust of seasoned accredited investors, right? Because they trust your partner, and then your partner will be able to, like, get you as a GP at the beginning, and then eventually you will be able to enter the industry on your own once you have a couple of deals under your belt with that partner, something like that, right?
Yeah. I think that if somebody's investing through you, they definitely have to. It's not necessarily that somebody else trusts your partner, right? Because yeah, they might trust your partner, but those investors are coming through you, so they definitely would like to probably see the track record of your partner. So I think, thinking about it from a perspective of, if someone else trusts your partner, then your investors should trust you because someone else trusts your partner, probably isn't the right thought pattern. I think what you need to focus on is building that trust between you and the investor, because that investor is trusting you to make sure that you are aligning yourself with the right team to be successful, right? Because they might not know your partner, right? For my first deal, my investors didn't know my partner, but they knew me for the person who was in commercial real estate, for the person who played with them in the NFL as well. And they trusted me and my opinions and thoughts through some of the things that I did maybe on social media or talked about on Facebook and things of that nature from a capital raising perspective. They trusted me through all of those mediums to invest with me because I also aligned with a partner who had that track record. So your goal should be getting your investors to trust you because you are the person that has aligned themselves or has the experience to execute on the returns that you say that you're going to do.
Thank you, Yannick.
So Yannick, given that now, we are entering into a new zone of higher interest rates, so your refi is going to hit you probably 5-7 years. So if you did your first acquisition about 2018, right? I think that's what you said, I believe. 2018 was your first multifamily acquisition?
It was 2021.
2021. Okay, so it'll be 2028 when you will hit your refi, right? For the commercial loan, correct?
No. So we knew that the we knew that the economy was going to turn. So what we did was we did a construction to perm loan. And what that allowed us to do was that allowed us to get some interest only up front that just converts into a permanent loan at a lower price. So for example, one of our deals, we started off with a 4.25 rate for 3 years on the interest only side, and that goes down to a 4% permanent loan after 3 years. And that allowed us to not have to worry about any sort of capital markets issue where we're seeing right now. And we don't have to refi or do anything. We can just kind of ride things through because we have that low cost debt in place, right? Those are definitely some things I think a lot of operators are looking at today, is getting into, some of the bank debt as well, especially with larger properties, because some of the banks, the smaller local regional banks, don't get to see a 100 unit property, right? Or a 50 unit property. A lot of times, a lot of those investors go to, maybe, Fannie and Freddie Mae, where they can get much better terms. But the smaller banks as well also have, they don't have like yield maintenance or large prepayment penalties that you would see in the agency side of things. So because of that, instead of getting into a deal today where you might get into, maybe a 10-year note, and you might have that step down prepay, a 5544332211, or maybe a yield maintenance, you can get into a bank loan today and they don't have an exit fee of that sense, right? They don't have any prepayment penalties. And once the market turns around, then you can refinance at a more favorable rate, maybe 24 months from today, right? So I think a lot of people are getting into those bank loans for those reasons. And then, you can always use a term sheet from a agency, loan broker, real estate broker, and take that to a local bank and then try to get them to compete as well.
Okay, interesting. So do you, but at the current rate, you basically are looking for the new acquisition, right? You'll be hoping that 4 to 6% cap rate, so the asset value has to come down, right? Comparative to what it was a year ago. So as a new buyer, your eyes would be on cap rate, maintaining cap rate of, let's say 4 to 6%, with a new interest rate of around, I would think, 7%. So which means that the asset price that was a year ago will has to be substantially down than like what I said was a year ago, right?
Yeah. I think a lot of people are doing deals differently from different ways. Some people are going through the loan assumption route, and they're taking the existing debt on the property, maybe around like 3.5%, and the deal pencils, and going in and just substituting themselves with the active owner, and servicing that debt until they can maybe refinance 24 months from now when they have executed maybe half of the business plan or so. Maybe some people are waiting on the sidelines and waiting for things to be repriced, which is somewhat what we're doing, and we're seeing in the market right now. We're seeing some deals that we've submitted on 6 months ago coming back to market in January. But I think in today's environment, I think now more than ever is really important to focus on fundamentals, because I think that the tailwinds behind multifamily has somewhat, like, it's almost ended to a sense. And when I say that, I'm talking about aggressive rent growth, 10 to 15%, I'm talking about, thinking that you're just going to get into a deal, and because of the capital markets and the liquidity out there, that someone's going to buy you out and you're going to 2x your capital to your investors. I think those days of underwriting and people getting bailed out is somewhat coming to an end. But certainly the fundamentals behind housing and the demand is still there. But I think ultimately, how you should look at things is, how can I protect my capital today, right? How can I get into deals that make sense from a realistic perspective, and not like have the seller's broker make you think that this market is going to appreciate from a rent growth perspective 5 to 6% for the next 3 years, right? And just relying on rent growth to grow that NOI and ultimately get to the sales price that you want at a lower cap rate because you think that the market is going to turn around in 36 months from now. I think definitely like looking at those deals from that perspective and figuring out, how can you get into deals from a risk adjusted basis is something that you should approach when you're looking at these deals, because I don't think that you're going to be able to get bailed out 36 months from now. So that's just kind of my thesis of how I look at acquisitions today.
Right.
Sounds good. Well, hey, I really appreciate you guys came with some good questions. Last week we had some great questions as well. Happy to have an offline conversation with anyone that is, looking to get into real estate or interested in getting into multifamily or has deals in other markets. I'm certainly happy to talk about that as well. And so, thank you guys for, tapping in today and joining the webinar. We're going to have another one next week. Probably going to release that on Saturday, but thanks so much and happy to connect with you guys offline. So thanks again for tuning in today.